And welcome back to the Women on Amazon podcast. This is episode 42. And so any show notes you'll be able to get on womenonamazon.com/42. And I'm joined today by Kevin Flaherty from Thrasio. Welcome, Kevin. How are you?
I'm doing well, Regina. Thank you for having me.
Oh, it's such a pleasure. I haven't had anybody on the podcast to date to discuss about exits. So we're going to talk today about Amazon sellers and exits. So firstly, do you want to tell me a little bit about the company you represent and what you guys do? And then we'll talk more generally about exit strategies.
Sure, absolutely. So I work for Thrasio, which started in September of 2018. It started with our two CEOs who were serial entrepreneurs themselves.
Mm-hmm.
And really, they were in the Amazon ecosystem prior to starting Thrasio.
Mm-hmm.
They had come across the FBA platform, and they really saw it as an interesting tool to democratize entrepreneurship. As I'm sure you and your listeners
absolutely.
absolutely.
It certainly changed my life and a lot of people I know. So yes.
Yeah. And there's such a low barrier to entry to starting your own business. And really they saw that it was really an area that was ripe for consolidation.
Mm-hmm.
So fast forward to 2 years to today, and from September of 2018 to today, we've been able to grow from our two co-CEOs to over 300 full-time employees.
Wow.
Yes. So, it's been busy, definitely been busy.
So what are all these full-time employees doing? What's the strategy of the company?
Yeah. So, we have been able to raise over $500 million of growth capital while remaining profitable. And so what we've done with that growth capital, and I should also mention in July of 2020, so about 2 months ago, we became the fastest US startup to reach that $1 billion unicorn valuation, which we're pretty proud of and pretty excited about. But we have been able to use that growth capital to really build out a world-class supply chain management team, brand management team, operations team, as well as product launch team, FP&A team to really focus in on inventory management as well as forecasting for the future for all of our brands, as well as our mergers and acquisitions team, which I'm a part of.
Right.
So, what we've done with all of those people has been able to grow and scale the business to the point where to date, we've closed over 70 transactions. By the end of this quarter, in 2 weeks, we should be closing, have acquired around 85 different brands that we own. And so we've definitely been busy in the mergers and acquisition space and then really scaling the brands that are within our portfolio.
Okay. So what you've done, let me get this straight, is you've raised money, out on the market or through venture capitalists, or, how have you done that?
Yep. So through private investors,
Okay.
with, some of the top venture capitalists in the industry, and, have raised it in that way and then have been able to, build the Thrasio structure and then used a lot of that allotted capital to go out and make acquisitions.
Right. And so you're then going out and buying existing Amazon brands that people like myself have built up, and then you take them under your umbrella, and because you've got the systems in place, you're able to, I guess, refine the profit margins and make more money out of it. Is that it? That's pretty much the basic.
Hitting the nail on the head.
Awesome. Now, just quietly between you and me, you may know one of my dear friends in the Amazon space has actually sold their business to you this year, and they were, very happy with how the transaction went, and think that's how you and I got together to have a chat, because it's really interesting. And I've been selling on Amazon since 2015, and it was around about sort of 17, 18 that in the groups that I'm in, that people started talking about, large exits. And I know, a few people who have sold through, various different means. So, and it's something that's very much on people's minds now, more so than ever before. Amazon is a great cash flow business. However, it's also a great way to build equity and then sell to a private concern through a broker, or to a large company like yourselves who can take it on and take that brand to the next level. So tell me, if I'm just starting out let's pretend I know nothing and I'm just about to start building an Amazon brand with a view to selling it. Firstly, what would be the timeline that I'd be focusing on from start to sell, in your opinion?
From starting a business to selling a business?
Yep, in this space.
Yeah, sure. So, let me take one step back
Sure.
and give you sort of a general idea of what we're looking for.
Okay.
And
Oh,
sort
yeah.
of
Okay,
as
great.
you're starting to sort of, you know, I'll say the bare minimum sort of
Sure.
stuff. First would be to make sure that your brand is trademarked. A lot
Yes.
of times, uh, guys will get really excited about a product that they might have and getting a storefront set up. And next thing you know, there's no trademark there. And for us, as the space becomes more competitive,
Mhm.
that becomes, essential for us to be able to.
And I know there's different types of trademarks. So you're looking
Yep.
for word marks or branding marks. Like, is there a particular type of trademark, or is it just that the brand itself is trademarks?
Yeah, so typically that the brand is trademarked in whatever sort of marketplace that it's operating in.
Hmm.
So in the U.S., there's your general sort of branded trademark. I
Yep.
know I believe in Europe and probably Australia as well. There's different sorts of trademarks,
Yes.
and so if you guys are selling in the European marketplace, I would recommend getting it trademarked there. If you're selling in the U.S. marketplace as well, getting it
Hmm.
trademarked there as well.
Right. Okay. So basically, you're wanting brand protection. So that's something. And of course, now with Amazon brand registry,
Hmm.
more and more brands are getting trademarks pretty much straight off the top.
Yep.
Starting, it's something that, again, earlier on, I don't think I trademarked my brand for until I was in business for 2 years. But these days, new sellers very much are trademarking their brands pretty much from the get-go. Okay, so that's number
Correct.
one. Okay, number two.
Yep. Number two, I would say, is really focusing in on your hero skew. So for us, and for what I would imagine a lot of the market is looking for,
Mhm.
is brands that, and I think that this is helpful for business owners who are just getting started.
Mhm.
Anyway, is every entrepreneur has a limited amount of capital, whatever
Yes.
that limit might be.
Mhm.
It's limited resources, and so I would recommend sort of setting up, optimizing the hero listing in
Mhm.
ASIN for your one product that you think is going to sell really, really well.
Right.
Professional photography, videography, professional copy, things along those lines,
Mhm.
just so that, we would much rather take a look at a business. Let's say it's on the smaller end,
Mhm.
doing $1 million of revenue.
Mhm.
If they're doing 900K and that's through one hero skew,
Mhm.
that's more interesting to us than say taking a look at $1 million business with 10 mediocre products doing $100,000 each.
Oh, interesting. Okay, that's an interesting take. I'd not thought of that before. So you'd be so as a seller, it would behove me to really put all my efforts into that $100,000 a month skew rather than
Yep.
a portfolio of skews.
Right.
Why is that?
For
Why is that, Kevin?
so Yep. So for us, the way that we think about it is, we're looking for product leaders and category leaders.
Hmm.
Sort of a perfect acquisition for us would be the number one selling spatula
Right.
in the spatula category,
Okay.
because there's going to be no innovation that's going to shake up the spatula's
Hmm.
utensil, right?
Hmm.
And being able to build a product that has a solid product rating, and isn't going anywhere
Hmm.
really plays to Amazon's strengths, where you can find these products around um, your home, and they're going to be around for
Yeah.
a longer period of time, shelf stable.
Hmm.
And so we're looking for those products that have the sort of social validation
Right. So you're looking
through.
for a large number of reviews. Is there a minimum number of reviews that you'd be looking for?
No,
Or
so
is it more of
it's
a
really
rating?
category by category.
Right.
So, if you're looking at betting and you have 2,000 reviews and
Mhm.
the number one, two, and three, products have 90,000, then, it's not super interesting. But
Right.
if you had 2,000 reviews and the top 5 had, 1,500, then it becomes more
Right.
interesting, and it just depends on
It's market by market, category by category.
exactly.
Right.
And
So really
to get back to your original question,
yeah.
relating to why we look at businesses that have a heavy concentration in those hero products.
Hmm.
For us, we've acquired over 70 brands, should be around 85 by the end of the quarter,
Hmm.
and so we own over 6,000 ASINs. So
Right.
for us, our portfolio theory is that we can continue to take on that concentrated risk because it's de-risked, across the portfolio, where a lot of other buyers would see that high concentration of revenue in that one product, and it might get a little skittish, just because, if that one listing goes sideways or
Yeah.
whatever, happens on Amazon, then, all your eggs are in one basket. Whereas for
Right.
us, it's a lot more attractive because of operational efficiencies.
Gotcha. Because you've got your risk spread across different categories and different products. You don't care if this one brand has just got one product. Okay.
Yep.
What about there's been a big push of sellers saying, okay, well, I've got to have my sell off Amazon as well, have my Shopify store, have my social media sorted. Do you guys look at that? Is that important for you when it comes to brand assets, when it comes to acquisitions?
Yeah, absolutely. So, when we're doing acquisitions, we're looking at acquiring 100% of the assets of the business, including sort of social media accounts, including Shopify accounts, other sales channels. I should also mention, we do share purchases in the UK for businesses that are domiciled in the UK, just because there's a specific tax advantage to
Right,
doing share
different. Okay.
purchases.
Hmm.
And so, we can be accommodative to that.
Hmm.
But the majority of our acquisitions end up being asset purchases. And so when that takes place, we do take over all of the off Amazon assets that pertain to it,
Hmm.
including intellectual property, trademarks, things along those lines.
Hmm.
I would say that historically we have placed a greater value on Amazon revenue, meaning
Right.
businesses that are doing anywhere from 80 to 100% of revenue on Amazon.
Hmm.
Uh, that said, we have done acquisitions of businesses doing less than 50%
Right.
of on Amazon revenue, and so we take it on a case by case
Right.
basis.
So,
Um,
so, so so again, if somebody is starting out or building their brand with a view to an exit, your
yep.
advice would be to continue to focus on the Amazon side rather than diversify into other marketplaces. Like Walmart is another big one that's starting to come up. So
Yep.
is for
And
you. So
I should also
advice would be to
mention that.
focus. Sorry.
Yeah. So I would also mention, Thrasio, as we've been able to grow and expand, we really view ourselves as the next generation CPG company. So, the Procters and
CPG is
Gamble,
what? Sorry, CPG.
uh, consumer packaged goods.
Right.
So think of a Procter and Gamble.
Yep.
So, the Procters and Gambles of the past really needed to own their manufacturing vertical,
Hmm.
where they could manufacture that one or two staple products
Yep.
very cheaply. They would also spend a bunch of capital on TV ad spend, where it was
Mhm.
sort of a spray and pray method,
Yep.
where they wouldn't be able to really target who they were trying to hit in terms of
Mhm.
ads. They didn't know how effective it was, et cetera. And they also needed to have a stranglehold on retail distribution.
Mhm.
Obviously, we all know, and I'm sure that your listeners know, that e-commerce has really flipped that model on its head.
Absolutely.
Smaller businesses can have nimble supply chains. You can really target your ad spend to the demographics that you think will be greatly affected
Mhm.
by those ads, and you can sell directly to the consumer, and reaching those marketplaces through marketplaces like Amazon or
Mhm.
Walmart. And you know so we have focused on our Amazon acquisitions for a couple of reasons. One, we think that they're nice cash flowing assets,
Mhm.
but two, we also realize that these businesses have um, product market fit, and they have historical track records of people purchasing them and enjoying them, and leaving reviews. So
Mhm.
what we've done is really use the Amazon acquisitions as sort of the research and development arm of Thrasio, as we've been
Right.
able to build out a Walmart marketplace team, an eBay marketplace team, as well as a brick and mortar retail team
Right.
to
Okay.
bring those Amazon native products eventually across platform
Gotcha.
into other sales channels to be able to get them into more consumers' hands.
Mm-hmm.
And so that's where I would say, again, the solo entrepreneur
Mm-hmm.
has limited
Of
resources,
course. Yeah.
limited capital, limited
And
time.
time.
Exactly. Exactly. And so, I would definitely focus on being very maniacal about growing your Amazon sales and growing your Amazon listings and building that sort of social validation with those products.
Mm-hmm.
And then when you're looking for an exit, look for a buyer that has the ability and the resources to be able to take it across platform.
Gotcha. So don't try and do it all yourself. Just focus on
Right.
that one thing. That's really good advice. Okay, so from a paperwork point of view. Oh, so what? Before we get to paperwork, just to clarify, so you would buy, if you're buying an Amazon brand, you're not actually buying the Amazon account, correct? You're buying the just the brand, or do you actually buy the Amazon account? Because
Yeah. So,
there
it
seems to be
sort of
different
depends
ways
on the
that people do
situation.
that. Sorry.
Sort of depends on the situation,
Right.
meaning, we can migrate the account over, or we could do, let's say that you own 3 different brands and
Mhm.
you're only selling, 1 or 2 of them. We can
Mhm.
carve out different ASINs and transfer them over to our
Right.
accounts.
Okay.
And so, it really depends on a situation by situation
Mhm.
basis.
Okay. And, as an overseas seller, I don't have
Mhm.
an LLC, for example.
Yep.
So is that an issue?
No, that's definitely not an issue. So we've purchased businesses, in Australia, like
Mhm.
yourself, as well as, the Philippines. We purchased them in the UK, Europe. Really, I would say in terms of paperwork or
Mhm.
what to think about as you're setting up a business is
Yeah.
making sure that a clear ownership structure is set in place.
Right.
And that it can be documented, by a lawyer and the whole 9 yards,
Can
right?
you clarify that? What do you mean?
Just making sure that sort of instead of having it run through your personal accounts or what have you, that there's sort of a clear business structure set up
Mhm.
so that it could be legally transferred over in the cleanest manner possible.
Gotcha. So if you're in Australia, it would be a proprietary limited company. If you're in
Correct.
the US, it's an LLC. If you're in the UK,
Yep.
it's a what is it? A proprietary. Oh, I can't remember what it is in the UK, and I've got one of those. It's still a company limited of some kind. Okay, so let's get down to the nitty gritty. You sort of mentioned before that you're looking for brands that are doing $1 million a year and over in turnover. What other metrics are you looking for?
Yeah. So, like I mentioned before, our size range in terms of acquisitions that we've looked at sort of ranges anywhere from on the lower end, $1 million of trailing 12-month revenue, all the way up to $100 million of trailing
Mhm.
12-month revenue. We have the capabilities to be able to purchase businesses of all sizes.
Mhm.
And, you know, really, aside from that, we're looking for products that are, pretty standard and not sort of subject to technology obsolescence, meaning,
Right.
I have this water bottle right here. We have a
Mhm.
nice brand on it and, it has nice product reviews, a solid review moat, and, it's ranking well within the Amazon ecosystem.
Mhm.
That's a great acquisition for us.
Right.
Things that we typically steer clear of are fads. I know that's a broad term, but you kind of know it when you see it. So
Yeah.
no
So no
fidget
fidget
spinners,
spinners. Yeah.
yeah. None
Mhm.
of those. We typically steer clear of fashion sort of items or
Mhm.
fast fashion or really apparel. Reason being is sort of the inventory management surrounding
Really
that and the
hard
different
with apparel.
variations and
Mm-hmm.
SKUs doesn't seem, is not, not worth it for us at the moment.
Mm-hmm.
And then we'll typically steer away from the supplement space, at least to date.
Right.
So, from that standpoint, what we're pretty much looking for is a product leader or category leader,
Mm-hmm.
and then not subject to technology
Right.
uh,
So
wiping it
no
away.
iPhone cases then?
No iPhone cases, exactly. So,
Selfie sticks, right? Okay.
right. But then in terms of sort of financial trajectory,
Mhm.
it's been interesting, quite frankly, in terms of the impact COVID has had on these different businesses.
Hmm.
It seems sort of binary. Some in the travel space or
Of
the
course,
automobile space for a time have been hit pretty hard.
of course.
Others, home fitness or arts and crafts have
Yeah,
really
quite nice.
exploded.
Yep.
Yeah. So really, the way that we're looking at those is trying to get a normalized view of the business,
Mm.
but understanding that a lot of what's been gained through COVID and the consumer behavior shifting to e-commerce
Mm.
likely isn't going to go away
No,
anytime
it's a
soon.
very much a long-term trend. What
Right.
about profit? We keep talking about turnover. Do you have a guideline that you're looking for profit? Because somebody could be doing $1 million turnover, but actually losing money, right?
Right. So, at this point, I've probably looked at over 250 to 300 different businesses
Hmm.
and different profit and loss statements.
Hmm.
Um, I would say that, on the lower end is probably that 10% range.
That's after everything, or do you look
After
at
everything,
profit, or do you look at margins?
so
In profit?
that's net margin is typically what we look at, which would be sort of sales on Amazon minus product costs minus Amazon fees,
Hmm.
minus marketing, and then minus operational expense.
Yeah,
So
because I would
software.
imagine that operational expense you can sort of really, uh, you know, gain some advantage on over something
Right,
new,
exactly.
right? Hmm.
Yep. And so, on the lower end, we've seen businesses doing, 10 to 12 percent of net margin, all the
Hmm.
way up to, 35% of net margin.
Hmm. And
Now, the
do you
way
have a
we sort of
preference?
fit, what's that?
Do you have a preference?
So, you know, we love to see higher margin businesses, right? Everyone does. That said, higher margins sort of lend themselves to be ripe for more competition. And
Hmm.
so you might be a leader today, but what does that mean, a year from now? And how does that space look as it's, shaking up?
Hmm.
Whereas if you look at a business that might have 10 to 12% margins, it might be a much more competitive space. But
Hmm.
if you have that sort of leadership rank there, and you've really established yourself with those solid product ratings and solid reviews, then we might be more apt to be able to take a look at that business, because the idea is, well, everyone else is going to take a look at it and realize it's going to be really expensive to enter that space.
Right.
And so really it's on a case by case basis, but on average we've seen a solid business would be between 15 to 25% of
Mhm.
net margin.
Yeah. Okay. And so, what sort of multiples are these businesses selling for, or like you're buying them? So, what do you buy? What sort of multiples do you buy for?
Yeah, and that's a great question that everybody asks, and it's tough to answer.
Okay.
The
So
reason
give
why I
us a
say that,
range.
sure. So I typically say, the market is the market, meaning, you know, the market is what a buyer will pay a seller for it,
Hmm.
and that sort of depends on a transaction by transaction basis, because there's always different underlying reasons. I've seen sort of on the for smaller businesses, anywhere from 2 to 3 times
Hmm.
on average is sort of
Now that's
that range.
now that's 2 to 3 times what?
Great question. Thank you. 2 to 3 times trailing 12-month seller discretionary earnings or net income.
Net income, right?
Yep.
Okay. So
Um, you know,
okay. Mhm. Now, if my
so
brand has grown, and let's say 12 months ago I was only doing, $30,000 a month, and this month I'm doing $200,000 a month, do you average it out, or is it just over that 12 months?
yeah, so I mean, that has come up a good amount throughout this COVID period,
Yeah.
where people have really popped, and so that has been a conversation, and it really depends, sort of brand by brand and product by product, of what are the reasons for this underlying sort of growth of the business. Is it directly related to COVID, right? Is it a product that is basically a thermometer, and
Mhm. Yep.
versus another home fitness or water bottle brand or what
Mhm.
have you, that it has an indirect sort of relation to COVID, but isn't directly
Yep.
correlated, right? And so just getting a better understanding of what's really going on there and what's driving that growth, versus eh, just blanket statements. And really, what it boils down to, I would say, is a conversation with the seller, and having the seller being upfront and saying, "Hey, look, this is what's going on, and here's why we think it's going on," and the whole nine yards, and just getting to a reasonable valuation that both sides can agree on.
Okay. So just some rough numbers here. Let's say if I'm turning over $1 million a year, I'm running a
Yep.
very low 10%, income after everything. So I'm making $100,000 a year. You're saying that you would buy my business for somewhere between $200,000 and $300,000. Is that
Yeah,
right?
yeah, that's typically what we've seen within the market. I can tell you, as you sort of get higher in the market, you know, EBITDA or seller discretionary earnings or net income, whatever you want to call it,
Mm-hmm.
gets closer to that, $4 million to $5 million range. You
Mm-hmm.
know, the market's probably closer to 4 to 6 times. Reason
Okay.
being for that
Mm-hmm.
is sort of, as you get higher in the market, you see a lot of different private equity funds, going down in the market and making more competition for some of these businesses. Meaning,
Right. Mm-hmm.
they're looking to do a one-off acquisition, or they really think that they can acquire the business, and it would be a nice bolt-on acquisition where they can shake out a lot of the inefficiencies of it. So they might be willing to, pay up for it because it is sort of in that bigger EBITDA bracket.
Right. So what you're saying is, if I've got a business that's $10 million in turnover, I'm likely to get a higher multiple for it than I am at the $1 million mark.
Yep.
Right.
Yep.
Gotcha. Is there a sweet spot? Again, as a solopreneur,
Yeah.
is there a sweet spot?
In terms of what we're looking at
Yeah.
or looking for,
Yeah.
oof, I would say if you told me that you had a business that was doing, 20 to $25 million of sales or turnover,
Mm-hmm.
and was making, anywhere from $4 to $6 million of that net income or EBITDA
Mm-hmm. Yep.
a year with, 2 or 3 hero products, I would
Mm-hmm.
love to be able to speak with you.
Right.
Um,
Okay.
that's a target acquisition for us.
Right. So anybody listening that's building a brand, there's your goal. Set that as a goal, because that would be an awesome, because so that would be what, close to a $20 million payout, right?
Yep. And I should also mention, the way that we operate is very streamlined and efficient,
Mm-hmm.
meaning, particularly if your revenue is heavy on Amazon, then
Mm-hmm.
all of the data that we're looking for comes from the back end of Amazon. So
Right.
our typical diligence process
Mm-hmm.
is pretty quick. I came from the private equity and venture capital world prior to starting Thrasio. So that diligence process can last anywhere from, quite frankly, 6 months to a year.
That's
And
crazy. Yep.
yeah. And for us, on average, we're able to, from the time that we sign a letter of intent
Mm-hmm.
to the day that we close, on average, is around 45 days.
Right.
So that would be,
Pretty fast.
pretty fast for sure. And, that would basically be, ballpark $20 million in your pocket, sort of 45 days from now, which I think is pretty nice.
Yeah, that'd be awesome.
Yeah. And, I would also like to mention sort of our term sheets. We end up signing, closing 98% of the term sheets that we sign.
Mhm.
So a lot of other buyers or private equity
Oh, there's
funds
a lot
might
of
come
a
in
lot
and,
of tire kickers out there, as we call them here in Australia. Do you call them that in the
yep,
US?
that's what we call them too. They'll sign you up for, 30 or 60 days
And
or even 90 days.
tie you up. You can't do anything else, and then walk away. Yep.
Right. So, we're not contingent on financing. We're able to purchase businesses all in cash. And then, typically when we sign a term sheet, we have every intention of purchasing that business, and so that's another added value for a lot of
Yes.
sellers
So,
as well.
so that was the other thing was, I know that in the past, people who have sold businesses have had they've done deals where it's X amount, percentage up front, and then, longer term payouts, and that becomes a risk for the seller as well. Is that something that you do, or do you just do 100% cash up front?
Yeah, so we typically do that sort of structured deal where there's a percentage up front. I would say it's the majority of the deal economics.
Mm-hmm.
There's a 1 year stability payment, and that's saying, hey, look, Regina, we know that there's a lot that can go wrong with Amazon. That said, there's some stuff that can be accounted for and other stuff that can't be. And in traditional mergers and acquisitions, there's something called a seller's note, which is saying, hey, look, I just want a stamp of confidence from the seller to say that the business isn't built on a house of cards.
Right.
So, whether that be, and I'm sure that a lot of your listeners aren't doing this, but black hat tactics or fake 5-star reviews or free giveaways.
Yeah, we certainly, in my ecosystem, we sort of stay right away from that stuff. Yep.
Of course. But you would be shocked at some of the things that we've seen.
Oh, I wouldn't.
Fair. So really, it's a stamp of confidence from the seller to say, hey, look, what you see is what you get. And I'm confident that my business will be able to continue to perform. Mm-hmm. And the way that that's typically structured is, as long as the business remains flat for the 12 months after we acquired the brand, you would be due that much smaller payment.
So which we're talking percentage-wise, what sort of percentage are you talking?
I would say anywhere from 15 to 30%.
Right.
And then, what we also do is sort of an earn-out component. So basically it's saying, hey, look, we think that there's a lot of upside to the brand, and I'm sure that the seller does as well. And we are fully confident in our ability to take these brands in, shake out inefficiencies and grow the bottom line. And although there's zero obligation that the seller would need to stay on to operate the business, we do want to allow the seller to continue to participate in that upside that we're able to generate, because we do think that these acquisitions, we think of them more as partnerships than anything.
Right.
And so typically the way that earnout is structured is the seller would be due 50% of incremental profits that we're able to generate over the acquired profit for typically 1 or sometimes 2 years.
Okay, can you explain that?
Yes.
That sounds a bit jargony to me. Can you dumb it down?
Sure. So let's say that your net income is $1 million for the last 12 months.
Yep.
We acquire the business. We're able to grow the business to $2 million after year 1. Then you would be due an additional $500,000 in that earnout structure. Reason being is, we were able to drive $1 million of incremental profit.
Right. So that's over and above the original agreement that you made. So there's a real upside. Is there a downside?
Not in terms of the earnout structure. It's more of just, if I'll say this, on average, we've been able to grow our brands around 180%. Our net income 180% 1 year after acquisition.
Wow.
The top quartile of brands have been able to grow around 400%.
Wow.
And so, we have a very solid track record of being able to produce outsized returns, which we think becomes very attractive for sellers who really believe in the long-term sort of value of their brand, but might not have the time, resources, capital, interest, or quite frankly, skill set to be able to take it to the next level.
Yeah, which is, again, most of us sort of working on our dining room tables are in that sphere. Okay, and one last question: non-compete. What is your philosophy around, because a lot of us, we like being on Amazon. So let's say I sell my brand. Am I allowed to build a new one? Like, what's your non-compete?
Absolutely. So we do have a non-compete, but it's typically, what we consider fair and reasonable. And basically what we mean by that is, if you just sold a business to us, we would expect that you didn't go out and continue your supplier relationships to source the exact same products to launch a new brand that would directly compete with us. Right.
Which is fair.
Yeah. So we do have, we have multiple sellers go sell their brands to us and then start other brands on Amazon And it might even be within the same category. Sports and outdoors, we don't want to completely ban you from the sports and outdoors space. It's just more of, directly competing with us.
Right.
And quite frankly, we love when sellers go out and start new brands. We think that this Amazon ecosystem is really a once in a lifetime sort of, opportunity to be able to grow and scale a business in the course of 2 to 3 years, get a meaningful, payout, and then take that capital to be able to go roll it into another brand and then do it again and sell in 2 to 3 years. Right. And so we love that, particularly because, it's another person or another brand that could potentially be sold to us in 2 to 3 years.
Yeah. Perfect. And so do you tend to buy directly from the sellers, or do you go through brokers? Because there's a lot of people who have set themselves up as Amazon brand brokers.
Yep.
What do you have a preference, or does it not really matter to you?
No, so I mean, at the end of the day, we are looking to purchase really excellent brands and assets. So
Mm.
whether that comes through, inbound, whether that comes through referrals, brokers, outbound efforts, we do it all. We don't necessarily have a preference. I would say, we're 50-50 broker to, inbound, and we have an outbound effort going where we're directly reaching out to brands that we find
Right.
interesting and just want to start a conversation with those guys.
Mhm.
And so when it comes to sort of, how we find the deal, there's no sort of preference as long as
Right.
it's a good deal.
Okay. Beautiful. Is there anything I've forgotten to ask that might be important for sellers who are building brands for an exit?
No, I think I think that covered it for the most part.
Oh,
Um,
I've thought of something.
sure.
So I just want to clarify, when you're buying Amazon businesses, you're buying purely private label brands, because there's a big
Yes.
push with people being resellers and wholesaling. And those businesses are also, able to be sold.
Yep.
But Thrasio, you're looking purely at private label, right?
Excellent point, and you hit the nail on the head. We're looking purely at sort of the private label FBA space.
Mhm.
Understanding, with COVID, some people did have to shift for a time to the FBM,
Mhm.
but looking mostly at the FBA and private label.
Right. So anybody that's building up a reseller or wholesale business, which are also of value, would be
Yep.
best to look at a brokerage rather than come to somebody like yourselves who's focusing on private label. Yeah.
Yep. And I should also mention, um, you know, we are currently selling in over 12 different Amazon markets, I believe.
Hmm.
And so, whether you are European centric, UK centric, US centric, we take a look at all sorts of
Right.
businesses and
Hmm.
have purchased all of them, or purchase businesses centric in each of those different markets. And so
Hmm.
we're agnostic really when it comes
Okay.
to
Where?
sort of where it is
Mhm.
and where it's selling.
Yeah. Fair enough. Terrific. And so if somebody wants to get in touch and talk to you about their brand, we'll pop a link in the show notes here where they can reach out to you directly. That's the best way to go? Yes.
Absolutely.
All right. Terrific. Thank you so much. It's been really very, very interesting. So anybody out there that's listening or watching this video that wants to look at a sellout or an exit rather than a sellout, an exit, and you have got a pure play private label brand, you can get in touch with Kevin and the team at Thrasio to have a look. So thank you.
Thank you, Regina. I appreciate the time.
Anytime.